This strategy involves simultaneously selling a put spread and a call spread on the same underlying asset with the same expiration date. It aims to capitalize on the lack of significant price movement in the underlying asset. The primary goal of the Iron Condor strategy is to profit from periods of low volatility in the underlying stock. This strategy involves setting up a position that earns income from option premiums and is successful when the stock price remains within a certain range. It combines the sale of both put and call option spreads, making it a popular choice for income generation rather than capital appreciation or speculation. How does the Iron Condor strategy adapt to changing market conditions? The Iron Condor strategy is best suited to stable, low volatility markets. It performs well when the underlying asset's price remains within a specific range, not exhibiting significant movement. However, in highly volatile markets, the strategy can be at risk as larger price swings increase the likelihood of reaching the strike prices of the sold options. Iron Condors are most effective in stable markets with low volatility. The ideal scenario is when the stock price fluctuates minimally and remains within a specific range. This strategy is less effective in highly volatile markets where significant price movements can breach the strike prices of the options, leading to potential losses. What is the risk profile for an Iron Condor strategy? The risk profile for an Iron Condor strategy is characterized by limited risk with a defined maximum loss. The maximum potential loss occurs if the underlying asset's price moves significantly beyond either the upper or lower strike prices of the spreads. This loss is limited to the difference between the strike prices of the spreads minus the premiums received. The risk in an Iron Condor strategy is limited and defined by the spread between the strike prices minus the net premium received. If the stock price moves outside the range of the strike prices at expiration, the maximum loss is realized. This loss is the difference between the strike prices of either the call or put spread minus the premiums received. What are the potential rewards of using an Iron Condor? The potential rewards of using an Iron Condor include income generation through the premiums received from selling the call and put spreads, with the gains being capped at the total premiums received. The maximum profit is achieved if the underlying asset's price stays between the strike prices of the sold options through expiration. The reward potential with an Iron Condor is capped at the net premium received from selling the option spreads. The best case scenario is the stock price remaining within the range of the strike prices, allowing all options to expire worthless and the trader to retain the full premium. However, the potential gain is limited to the premiums received, irrespective of how the market performs within the range. What are the considerations for implementing an Iron Condor strategy in stock options trading? Key considerations for implementing an Iron Condor strategy include choosing appropriate strike prices and expiration dates for both the call and put spreads, ensuring these strike prices form a range that the underlying asset is likely to remain within, and monitoring the market to manage the position as needed. The trader must also be prepared to take appropriate actions if the market starts moving towards either range's limits. To implement an Iron Condor strategy effectively, traders should identify a stock with low volatility and little expectation of significant price movement. Sell an out-of-the-money put spread, which entails selling a put and buying a put with a lower strike price and an out-of-the-money call spread. This means selling a call and buying a call with a higher strike price, both with the same expiration date. Choose strike prices that define the anticipated range of the stock price and consider the potential profit and loss scenarios. Calculate the net premium received, which is the income from selling the spreads, and understand the maximum potential loss. Monitor the stock price regularly to ensure it remains within the desired range, being prepared to make adjustments if market conditions change significantly. An Iron Condor strategy in stock options trading requires a precise understanding of market conditions and volatility. It is suited for traders seeking to generate income in stable markets, offering a balance between limited risk and capped potential gain. Careful selection of strike prices and diligent monitoring of the stock are crucial for the success of this strategy.